Most people spend their entire lives working for money without ever understanding how money actually works. They earn, they spend, they save what's left, and wonder why they're still stuck in the same financial position years later. The wealthy don't work harder, they work differently. They understand that money is a tool, not a goal. And today, we're going to give you the complete operating manual that should have been taught in school but wasn't. This isn't about getting rich quick or speculative gambling. This is about building a financial machine that prints money while you sleep, systematically, predictably, and with mathematical certainty. Let's start with the invisible force controlling your financial life, your money psychology. Research shows that 80% of personal finance is behavior, only 20% is knowledge. Your beliefs about money, formed in childhood, dictate every financial decision you make. If you believe money is scarce, you'll hoard it and miss opportunities. If you believe money is evil, you'll subconsciously repel it. If you believe you're bad with money, you'll prove yourself right. The first step to wealth is rewriting these invisible scripts. Write down your earliest money memory. Was it scarcity? Conflict? Shame? Now ask, does this belief serve the person you want to become? If not, replace it deliberately. Money flows to me easily. I am a skilled capital allocator. Your brain will find evidence for whatever you tell it. Now let's build your financial foundation, the boring but bulletproof base that makes everything else possible. Step 1, know your numbers. Exactly how much comes in, exactly how much goes out, categorized and tracked for at least 90 days. No estimates. No rounding. The 50/30/20 rule is a starting framework: 50% needs, 30% wants, 20% savings and debt paydown. But if you're serious about wealth, flip it. Live on 50%, invest 30%, enjoy 20%. Your future self is counting on the gap between your income and your lifestyle. Automate everything. Willpower is a finite resource, don't waste it on bill payments. Set up automatic transfers the day your paycheck hits, emergency fund, investments, guilt-free spending. You'll never miss money you never see. This single habit puts you ahead of 90% of earners. Before you invest a single dollar, you need an emergency fund, 3 to 6 months of expenses in a high-yield savings account. This isn't an investment. It's insurance against life's inevitable chaos, job loss, medical bills, car repairs. Without it, you'll raid your investments at the worst possible time. High-interest debt, credit cards, payday loans, anything above 7% is a wealth destroyer. Mathematically guaranteed. Pay this off before investing beyond employer matches. The avalanche method saves the most interest, the snowball method builds momentum. Pick one and execute ruthlessly. Now the engine of wealth, investing. The stock market has returned roughly 10% annually for a century. But most investors earn far less because they panic sell during crashes and chase hot stocks during bubbles. The solution is boring, brilliant, and mathematically superior: low-cost, broad market index funds. An S&P 500 index fund gives you ownership in 500 of America's best companies for 0.03% fees. A total market fund gives you the entire U.S. economy. Add an international fund for global diversification. 3 funds. That's your entire portfolio. Rebalance once a year. Ignore the noise. This is where compound interest becomes magic. $500 monthly invested at 10% becomes $100,000 in 10 years. $330,000 in 20 years. $1.1 million in 30 years. The first $100,000 takes the longest. Every $100,000 after comes faster. Time does the heavy lifting if you start now. But you must stay invested. Missing just the 10 best market days over 20 years cuts your returns in half. Those days cluster around the worst days. You cannot time the market. You can only time your discipline. Set up automatic monthly investments and delete the app from your phone. Tax efficiency is the silent wealth accelerator. Max your 401k match first, that's 100% instant return. Then Roth IRA for tax-free growth. Then HSA for triple tax advantage. Then back to 401k. Then taxable brokerage. Every dollar saved in taxes compounds for decades. This order alone can add 6 figures to your net worth. Real estate deserves mention not as speculation, but as a diversifier. REITs in your brokerage give you real estate exposure without toilets or tenants. If you buy property, run the numbers coldly: cap rate, cash-on-cash return, appreciation assumptions. Your primary residence is consumption, not investment. As your portfolio grows past $100,000, consider asset allocation: 80-20 stocks/bonds for aggressive growth, 60-40 for balance, glide paths for approaching retirement. Rebalance annually to sell high and buy low automatically. This discipline captures the only free lunch in finance: diversification. Insurance protects your wealth-building machine. Term life insurance if others depend on your income: 10x salary, 20 to 30-year term. Disability insurance: your income is your biggest asset. Umbrella liability policy: $1 to $2 million costs pennies. Skip whole life, universal life, and investment-linked products. They're expensive wrappers for mediocre returns. Estate planning isn't for the wealthy, it's for anyone who cares what happens to their people. Will, durable power of attorney, healthcare directive, beneficiary designations on every account. A $200 online package beats the state deciding for you. Review annually or after major life events. Now the mistakes that derail wealth. Lifestyle inflation: every raise increases spending, not investing. The hedonic treadmill means you'll adapt to the new car in 3 months, but the lost compound interest is gone forever. Live like a resident while earning like an attending. Fear-based selling during crashes. The market drops 20%, you panic, sell, miss the recovery. Historically, every crash has been a buying opportunity. If you're investing for 20+ years, a crash is a sale. Change your mindset: cheer for lower prices while you're accumulating. Chasing performance. Last year's hot sector is next year's dog. RKK, crypto, meme stocks: by the time you hear about it, the easy money is gone. Boring diversification beats exciting concentration every decade. Be the casino, not the gambler. Analysis paralysis. Waiting for the perfect time to start. The perfect time was 20 years ago. The second best time is today. Lump sum investing beats dollar cost averaging 2/3 of the time, but DCA beats never starting. Pick a date, pick an amount, start. Perfection is the enemy of wealth. Ignoring fees. A 1% advisor fee sounds small. Over 30 years on a $1 million portfolio, it's $1 million plus in lost wealth. A 0.03% index fund fee costs $30,000. That difference buys a house. Be fanatical about costs. Every basis point compounds against you. Your 90-day action plan. Week 1, track every dollar. Week 2, build $1,000 starter emergency fund. Week 3, capture full 401k match. Week 4, open Roth IRA, set up $500 per month auto invest into VTI or VOO. Month 2, kill high interest debt. Month 3, full 3 to 6 month emergency fund. Then, never stop. Track one number monthly: your net worth. Assets minus liabilities. Watch it grow. This single metric aligns every decision. Does this purchase increase or decrease my net worth? Does this career move accelerate or delay financial freedom? What gets measured gets managed. Find your tribe. You become the average of the 5 people you discuss money with. Join FIRE communities, Bogleheads forums, local meetups. Share wins, ask questions, stay accountable. The path is lonely without companions who understand the game you're playing. Define your enough. More money stops increasing happiness around $75,000 to $100,000 annually for emotional well-being, though life satisfaction keeps rising. Know your number. When you hit it, you can work because you want to, not because you have to. That's the true definition of wealth. Teach this to someone else. Your kids, your partner, your younger self. Financial literacy compounds across generations. The greatest inheritance isn't money, it's the knowledge of how to build, keep, and grow it. Break the cycle. Start the legacy. You now have the complete framework. Psychology. Foundation. Automation. Investment. Tax efficiency. Protection. Discipline. The only variable left is you. Will you execute? Will you stay the course when it's boring, when it's scary, when your friends are buying boats on credit? The market will crash. You will lose your job. Emergencies will happen. But if you've built this machine automated, diversified, tax optimized, protected, you won't just survive. You'll buy assets on sale while others panic sell. That's how generational wealth is built. One boring decision at a time. Start today. Not Monday. Not next paycheck. Today. Open the account. Set the transfer. Buy the index fund. Your future self is watching, and they're either thanking you or asking why you waited. The choice is yours. The time is now. Let's build.